Hey everyone! Welcome back to our channel. Today, let's dive into the exciting and dynamic world of Forex trading. Forex, short for foreign exchange, is like a giant global market where currencies are traded. It's the largest financial market in the world, with a daily trading volume exceeding $6 trillion. Think of it as exchanging money when you travel, but on a much larger scale. Instead of just swapping a few $100s, imagine dealing with millions or even billions. Traders buy and sell currencies, hoping to make a profit from the fluctuating exchange rates. These fluctuations are influenced by various factors like economic news, geopolitical events, and market sentiment. It's fast-paced, exciting, and full of opportunities if you know what you're doing. But it can also be risky, so it's important to be well prepared. Imagine you're holding US dollars and you believe the euro will strengthen against the dollar. This belief might be based on economic indicators or political events in the eurozone. You would buy euros with your dollars, essentially betting that the euro will increase in value. If your prediction is correct and the euro rises in value, you can then exchange your euros back into dollars for a profit. This process is known as going long on a currency pair. That's the basic idea of Forex trading. But there's so much more to learn. Trading in the Forex market requires knowledge, strategy, and a good understanding of market dynamics. It's not just about luck, it's about making informed decisions. That's where support, resistance, supply, and demand zones come in. These are technical analysis tools that help traders identify potential entry and exit points. These are key concepts that can help traders make more informed decisions and potentially increase their chances of success. Understanding these zones can give you an edge in the market. Are you ready to learn more? There's a whole world of strategies, tools, and techniques waiting for you. Let's go on this journey together and unlock the secrets of Forex trading. In Forex trading, a support level is like a floor that holds the price of a currency pair from falling further. This level is crucial for traders as it helps them identify potential buying opportunities. When the price of a currency pair approaches this level, it often attracts buyers who believe the price will not fall any further, thus creating a floor. It's a price level where there's historically been a significant amount of buying interest. This interest is usually due to traders' perception that the currency is undervalued at this level, making it an attractive entry point. Over time, these levels become psychological barriers where traders expect the price to bounce back up. This buying pressure prevents the price from dropping below this level, at least for a while. The more times the price tests this level without breaking it, the stronger the support becomes. Traders often look for these repeated tests as confirmation of a strong support level. Think of it like a safety net. Just as a safety net catches a falling object, a support level catches a falling price. This analogy helps traders visualize the concept and understand its importance in their trading strategy. As the price of a currency pair falls, buyers step in at the support level, creating demand and pushing the price back up. It's like a trampoline. The price hits the support level and bounces back up, often leading to a temporary upward trend. This bounce can provide traders with short-term trading opportunities. The price bounces back up from the support level. This bounce is a critical signal for traders, indicating that the support level is holding strong. It can also be a sign for traders to enter a long position, expecting the price to rise. Support levels are not unbreakable, though. They can be tested multiple times, and each test weakens the level. Traders need to be cautious and watch for signs of weakening support. If the selling pressure is strong enough, the price can break through the support level. This is often accompanied by a surge in trading volume, indicating a significant shift in market sentiment. This is called a breakout, and it often signals a further downward trend. Breakouts can lead to substantial losses if traders are not prepared. Therefore, it's essential to have a plan in place for such scenarios. However, understanding support levels can give traders an idea of potential price reversals and entry points for their trades. By analyzing historical data and current market conditions, traders can make informed decisions and improve their chances of success in the Forex market. Support levels are a fundamental concept that every trader should master to navigate the complexities of Forex trading effectively. Now let's talk about resistance levels. These are like ceilings that prevent the price from rising further. It's a price level where there's historically been a significant amount of selling pressure. Imagine the price of a currency pair going up. As it approaches a resistance level, sellers step in and start selling, pushing the price back down. It's like hitting a ceiling. Just like support levels, resistance levels are not absolute barriers. If the buying pressure is strong enough, the price can break through the resistance level. This is called a breakout, and it often signals a further upward trend. However, understanding resistance levels can help traders anticipate potential price reversals and identify exit points for their trades. Here's a cool thing about support and resistance levels. They can actually switch roles. Once a support level is broken, it often turns into a resistance level. Similarly, a broken resistance level can become a support level. Think of it like this. Imagine a price breaking through a floor. That broken floor now becomes a ceiling above. The same logic applies to support and resistance levels in Forex trading. This role reversal happens because traders' psychology changes when a level is broken. For example, if a support level is broken, traders who bought at that level may see it as a loss and be hesitant to buy again at the same price. This creates selling pressure, turning the broken support level into a resistance level. Section 5. Supply and demand zones, where the action happens. Now, let's move on to supply and demand zones. These zones are crucial in understanding market dynamics and can significantly impact your trading strategy. These are broader areas on a price chart where there's a significant imbalance between supply and demand. This imbalance is what drives price movements in the market. A supply zone is an area where there's a lot of potential selling pressure. This is where sellers are more likely to step in and push the price down. It's like a warehouse full of sellers ready to unload their currencies. When the price reaches this zone, it often faces resistance and may start to decline. A demand zone, on the other hand, is an area where there's a lot of potential buying pressure. Buyers are more likely to enter the market here and push the price up. It's like a shopping mall full of eager buyers. When the price hits this zone, it often finds support and may start to rise. These zones are typically wider than support and resistance levels and represent areas rather than specific price points. This makes them more flexible and often more reliable. They are formed based on historical price action and indicate where large traders and institutions have shown interest in the past. This historical data can provide valuable insights into future price movements. Understanding supply and demand zones can help traders identify high-probability trading opportunities. By recognizing these zones, traders can make more informed decisions and potentially increase their chances of success. For example, if the price enters a demand zone, it suggests that there's a higher chance of the price bouncing back up. This can be a good opportunity to enter a long position. Conversely, if the price enters a supply zone, it suggests that there's a higher chance of the price dropping down. This can be a signal to enter a short position or to exit a long position. It's important to note that these zones are not foolproof and should be used in conjunction with other technical analysis tools. Combining supply and demand zones with indicators like moving averages or RSI can enhance their effectiveness. Additionally, keeping an eye on news events and economic data can help you understand why these zones are forming and how they might be impacted in the future. By integrating supply and demand zones into your trading strategy, you can gain a deeper understanding of market behavior and improve your ability to predict price movements. This knowledge can be a powerful tool in your trading arsenal. So, take the time to study these zones and incorporate them into your analysis. With practice and experience, you'll become more adept at identifying and trading within these critical areas. Remember, the key to successful trading is continuous learning and adaptation. Stay informed, stay flexible, and always be ready to adjust your strategy as the market evolves. In conclusion, supply and demand zones are where the action happens in Forex trading. Mastering these zones can give you a significant edge in the market. So, keep practicing, keep learning, and may your trading journey be profitable and rewarding. Section 6. Zones versus levels. Spotting the difference. So what's the difference between support resistance levels and supply-demand zones? While they both indicate potential areas of price reversal, there are some key differences. Support and resistance levels are specific price points on a chart. They are like lines in the sand. Supply and demand zones, on the other hand, are broader areas on a chart. They are like regions on a map. Support and resistance levels are usually identified based on recent price action, while supply and demand zones are identified based on historical price action, often looking back further in time. Think of it like this. Support and resistance levels are like short-term battle lines, while supply and demand zones are like long-term strategic areas. Both are important for traders to understand, but they serve different purposes. Section 7. Visualizing the game charts and diagrams. To really understand how support, resistance, supply, and demand zones work, it's helpful to see them in action on a price chart. As you can see from the chart, these levels and zones act like magnets and barriers for the price. The price often bounces off support levels and resistance levels, and it tends to reverse direction within supply and demand zones. By recognizing these patterns, traders can make more informed trading decisions. Section 8. Why it all matters. Making smarter trades. So, why are support, resistance, supply, and demand zones so important for Forex traders? Because they can help traders make smarter trades. By understanding these concepts, traders can identify potential entry and exit points for their trades, set realistic profit targets and stop-loss orders, gauge the strength or weakness of a trend, anticipate potential price reversals. In short, these concepts provide traders with valuable insights into market sentiment and price dynamics. They help traders make more informed decisions, manage their risk more effectively, and potentially increase their chances of success in the Forex market.